You are 29, competent and trusted. Your MD leaves the room during your presentations as a silent endorsement. You analyze mid-cap industrials at a Chicago asset manager overseeing $4.2b across 60 positions. 8 of those positions are yours. Your routine is mechanical. Arrive by 6 a.m. with 3 screens glowing. You parse earnings releases and hollow sell-side updates. You believe markets are mechanisms for price discovery. Your job is to spot where they read wrong. Then the call comes from a number you don't recognize. Garrett Whitmore represents a family office with $3.1b in private assets. They own 22% of Ardent Industrial, one of your 8 positions. They bought it 11 years ago at $4.12, now worth $31, a 600% return. You ask why they don't T-sell, as basic portfolio management suggests. Whitmore's gaze is that of a chess player watching a queen blunder. He walks you through the math: 20% federal gains, 3.9% net investment tax, and 4.9% Illinois state. On $280 in unrealized gains, selling triggers $80 in taxes permanently. Or, he says, sliding a term sheet across. It's the cost we choose not to pay. The wealthy don't sell, they collateralize. Pull your last brokerage statement and circle every unrealized gain. Calculate the tax due if you sold today. That's your leverage cost. Stop thinking in exits and start thinking in terms of borrowing against appreciation. This is how capital stays capital. The numbers glare back at you from the spreadsheet. $34, $2 million in embedded capital gains on the water utility. At a 23.8% capital gains rate, that is $8.14 million due the 15th of April. The Patriarch's pen hovers over the $120 million offer while you calculate the real cost. Selling nets $111.86 m after taxes. Borrowing $40 at 3.4% cost $1.36 m annual interest. Utility throws off $4.07 m in annual cash flow. After debt service, $3.34 m remains tax-free in 33. 5 years, the debt repaid with dollars worth half their current value. The asset still compounds. The Patriarch slides the offer sheet back across the table without handshakes. Whitmore shows you the family S1986 tax returns. The last time they sold an income-producing asset. The math hasn't changed since then. Only the zeros have grown. Circle every position held under 12 months in red. Calculate the short-term gain and multiply by 48%. S what you pay to trade. The system wants you to sell, but the math wants you to hold. Choose your side. The offer was never about the $680 million. The Sovereign Wealth Fund S bid was just noise. The Patriarch asked, what do we borrow against it today? The answer, $290 million at 4.1%. Enough for the next project. Selling is in a transaction. It's surrender, a permanent claim on productive output traded for temporary cash. Cash taxed at 23.8%, spent on liabilities or reinvested into lower yield assets. The wealthy don T-sell says liquidity is a trap. Take the tech founder with $1.4 billion in a single equity position. Selling would trigger a $340 million tax bill and crater the stock. Instead, an exchange fund defers the gain entirely. He calls from a boat, feeling like he S1 because he didn't have to sell. Leverage isn't risk, it's a tool, a way to extract liquidity from illiquidity without touching the asset. Real estate isn't just rent, it's collateral for the next acquisition. Assets aren't a stack, a lattice. Pull up your largest position and calculate the tax due if sold today. Divide that by the asset's annual yield, that's how many years of cash flow you rehanding to the IRS. The math doesn't lie. The $260 million tax bill isn't an expense, it's a forfeiture. That payment could service debt on $3.7 billion in acquisitions at 7% interest. The $38 million annual income stream implies a $950 million asset at a 4% cap rate. Selling destroys what borrowing preserves. The activist spreadsheet treated real estate as inventory, not infrastructure. A $940 million embedded gain isn't profit, it's trapped energy. The family's leverage capacity grows $19 million yearly from inflation alone. Their weapon, a 21% interest rate on $500 million in debt fixed until 2039. Structural power operates in 3 dimensions: time arbitrage, yield asymmetry, and control premium. The playbook is mechanical. Call your broker's commercial lending desk at 3 p.m. tomorrow. Request the in-kind transfer form for your largest taxable account. Pledge the securities as collateral against a 60% LTV line at SOFR plus 125 BPS. The wealthy don T-sell because liquidation is arithmetic suicide. Every dollar of realized gain requires $1.30 in new investment, returns to regain the lost position. The game isn't T-valuation, it's velocity. Freeze all sell orders above $50,000 until you V-run the debt scenario. The illusion of control is your first mistake. You a temporary custodian in a multi-generational relay race. The $2.8 billion offer is a tax trap disguised as an exit. Run the numbers again. $1.9 billion embedded gain means $380, $560 million vanishes before the wire clears. Here is the only equation that matters. Forced sales convert dormant gains into active tax events. Every tax payment reduces compound growth vectors. Every reduced vector weakens the next generation. S starting position, your grandfather's we do not sell was forensic tax avoidance. Tonight, move the sell. Order threshold to $250,000. Schedule an 11:47 a.m. call with Zurich. Not earlier when hunger clouds judgment. Assets move sideways, never vertically. Tomorrow, S-market open is relevant. The real clock ticks in 3 weeks. Silence the spreadsheet, freeze the orders.